Nicole, let's start with you because it's been an interesting earnings season thus far. Obviously, stocks fell last week, but we have also not necessarily been seeing companies that be rewarded by the same magnitude that they have been in recent quarters. And even some companies that beat are getting punished. So what do you make of it?
Yeah. I think it's interesting. All of last week, we kind of had this thesis among ourselves that, the market was kind of looking for a new bottom, this place where, we could level set and have upside from here. And I would say in some of the action today, it looks like we might have found that footing. And when we think about kind of Netflix is my favorite story of last week, just the punishment for forward guidance and some of what they're going to claw back in terms of what they give us, starting next year. To us, it's just all this playing out of where does the earnings growth for the rest of the year come from? And we had anticipated a deceleration from those mega tech names in the back half of this year. And so kind of below the surface, we see this churning, the broadening that everybody's talking about, and then some of that relative outperformance from places like the equal weight S&P.
All right, Michael, just your overview. How has earnings proceeded so far? Where do you expect it to go?
Well, I think the biggest surprises that have come out of earnings in general have been things like General Motors' announcement today that was accompanied by an astonishing buyback where they shrank the quantity of shares by around 17%. This is in contrast, that level of buyback is unprecedented for many of these companies for that to be happening in open markets. And it's just highlighting that the exceptionally cheap areas of the market, as long as there's a little bit of support that's coming in through the interest rate space, that really looks like that could be an area of focus. Now, of course, if the mega cap names continue to disappoint, and I find it somewhat ironic that in a time period in which we heard announcements this morning that Apple was having its worst quarter in China since 2020, and we've seen some similar data that comes in to support similar dynamics, that we're very focused on the idea of where the earnings for the market is coming from. Clearly, the earnings from the market is coming from cheap stocks that have been buying back their shares. And if we can get some of a backdrop in terms of a reduction in interest rates, of backing off of the fears of inflation or the potential for the Fed to hike, there are areas of this market that are outright cheap.
Nicole, it's interesting when you're talking about, the valuation conversation, if you will, because you mentioned Netflix, for example, which is not one that folks would think of as a cheap stock per se. So how are you sort of weighting valuation right now?
Yeah, I think this all comes down to what side of strategy you're on. And really don't mean that as a cop-out. I think there's a place for being a trader and there's a place for being an investor. And so one of the mandates that we look at most specifically is, how are we tracking to the S&P in terms of, are we owning best-in-class management, best-in-class business across sector? And so this just is a unique opportunity, I would say, and maybe unique is a bigger word, but it's just one of those periods of time where you look at some of these mega cap companies and they've almost been like your piggy bank. And so now you're seeing kind of this shaving off, this redistribution, broadening of the market. You can say this in so many ways, but I do think if you're looking at, your own portfolio and you say, I'm underweight in certain sectors, then yes, Netflix is cheaper to buy today than it was. Similarly, Meta would be of the same vein. And so it's just, if you missed it in semis and you were underweight in the last run of NVIDIA, and you were fortunate enough to take some of that opportunity over the last couple of days to shore up your holdings, that's more where we're operating from.
Michael, I want to jump back. You mentioned some cheap sectors before, and you were also talking about interest rates. Could you go specifically what you're thinking there? How does your view of the interest rate structure, where you see it now, where you see it going, what does that cause you to think might be an opportunity here?
Well, the areas that we're seeing strength today, areas like automotive, for example, when you talk about cheapness, yes. I understand that these are cyclicals. I understand that we have come through a cycle at this point that many people were concerned about the idea that we could go into a recession. But when you see a company like General Motors trading at 5 times earnings, in contrast to some of the larger cap names, obviously trading at much, much higher multiples, it sets the stage for them to do the exact same thing that they just did, which is to buy back an extraordinary amount of shares. We've seen this in coal companies. We're seeing this now in the old industrials. And despite all the headlines about, the chaos caused by a new UAW contract at high levels of compensation increase, it really is not slowing these companies down. What is slowing these companies down is the level of interest rates and the inability of consumers to finance the products. And so if there are solutions to that in the form of lower interest rates or even just relief and a time period of adjustment in which people can get used to much higher interest rates, then these companies could be well positioned. That's really going to be the key question. Do we get any interest rate relief that gives consumers a little bit of extra spending power for these companies to continue to buy back the extraordinary shares that they've been buying back?
And Nicole, it sounds to me like, well, what is your position on interest rates and where they're going and how much that's factoring into your investment decisions?
Yeah, and so I think Michael has made just some great points during this conversation. And to piggyback on something he was just saying, about the rate of financing, a name that we added to one of our strategies fairly recently would be John Deere. So of that same vein, they also have done some interesting work adding Starlink. We've seen a lot of agriculture go to South America where Starlink is going to be, bring internet to combines that you're not going to get from 5G networks because they don't exist there. And so, I do think that there's room for some of these companies if and when we do get that first rate cut. To us, the market as a whole did a really great job of moving from 6 cuts priced in to 3 cuts priced in with barely a hiccup. There's a little bit of this now, churning towards, okay, what if we get 0? To us, it's still a little bit early to say that cuts are off the table for this year. There has been no doubt in our minds that wealthy individuals, right? So going back to this bifurcated market, the bifurcated consumer, we're actually being rewarded by interest rates being as high as they are. They weren't using debt to finance second, third homes, flying Delta One. I mean, there's just this population of people, this concentration of wealth that's keeping the economy very stimulated and has not been slowed down by higher rates. And so we do believe that the Fed wants to make that first rate cut. And at the same time, the data over the last 3 months and some of the data that's come to light just in the last couple of days, continues to cause concern for the slowdown isn't really happening the way that it had been anticipated. And yet I still do think there's a lot of sensitivity to who is that consumer, because we have to make sure that we don't crush the bottom, in support and continued support of the top.
Yeah, we got to go here, but really appreciate you both stopping by, Nicole and Michael.